It's okay. Thank you. Mark, do you want to start off with introductions?
Yes, I'm Marty Jacobs, and I'm on the Retiree Affinity group. And we're happy to have with us representatives from Bolton and Company, and they're going to present the innovative pension funding strategies for agencies. And Bolton is specialists in pensions, and we're glad to have them with us this morning. And with that, I'll let them get started.
Great, thank you. Mark?
Good
Yes.
morning, everyone. Yeah, my name is Mark Anderson. I am a consulting actuary with Bolton. I've been working in pensions for about coming up on 17 years here. So I had a good amount of time in my career working on many plans, both in public sector and in the single employer space.
I'm Tom Vicente. I'm also consulting actuary at Bolton. I've got a couple extra years on Mark, as you can tell by the tone of my hair. Been doing this about 30 years. Today's topic is interesting. It's topics that we don't always talk about in our day-to-day work with our clients on pension plans. So some different things that this seems like a good forum to bring them out there and sort of see what folks think about them. There are things that are done a little less regularly than sort of the conventional approaches. I think as part of this, I think the GFOA asked that for people who have questions, go ahead and use the chat feature to put the questions in there, and we'll try to answer them as we go if there's something that comes up while we're talking. Otherwise, we'll try to have an open forum at the end. We're thinking our presentation will be 45 to 50 minutes, so it will not be the full 2 hours that was blocked out for this. So there's plenty of time for discussion afterwards. With that, I'll ask Mark to share the presentation and take it away.
All right. Can everyone see my screen and can you hear my voice?
Yes.
All right. Well, thanks everyone for joining us and thank you for having us today. I really do appreciate your time and attention today. Tom, thanks for the lead in. I think with that, we can jump into the materials. First thing we have here is a quote from Warren Buffett saying, "Someone's sitting in the shade today because someone planted a tree a long time ago." So what we want to talk about is that planning process. How do we plan about funding the retirement plans and successfully funding them so that it can be a successful plan and have sufficient funds for retirees when they're ready to start taking their benefits? On the agenda today, we're going to start with some background, just some of the basics behind the valuation work that we do, how we get to the numbers, and what some of the terminology means. So want to make sure that we go over that. We'll try not to spend too much time on it, but want to at least set the background there. And then we'll go into some of the conventional approaches for funding a pension plan. And after that, we're going to talk about some of the more innovative ways to manage the amortization bases. And we'll talk a little bit about what those amortization bases are and how they're established and then how they might be amortized in the future, because there's some flexibility there. And that's where you might be able to get creative and help with managing volatility. We're also going to talk about smoothing of contributions, kind of related to the amortization concept, but more in a broad sense when it comes to the funding policy overall and how that can be smooth. And then finally, we'll talk about what to do if you do have surplus in the plan and how to manage that. And like Tom said, we will plan to save some time at the end for some discussions, but also feel free to drop any questions in the chat as we're going, and then we can address those topics as we're talking through them, so then we don't have to circle back to topic. If you do have a question that's relevant as we're going through the materials, happy to pause and take questions as we're going. So with that, we can start with the background. Funding a pension plan really comes down to a basic equation. It's contributions and investment earnings. That's what's going into the plan and what it's earning on its investments. At the end of the day, needs to equal the amount that's going to be paid out to participants and also to pay plan expenses. So today we're going to talk a lot about the contribution portion of that equation. We don't have any magical answers to say that contributions can be less over time. Ultimately, they're, you do have to fund the plan to get to pay the benefits. But what we do want to talk about is avoiding the spikes and volatility year to year and some of the options that are there so that it's easier to manage and easier to predict those contribution amounts. You don't have the surprises coming up, or can at least mitigate some of the surprises so that they aren't as big of a shock to budgets. When we think about funding policy, there's a number of objectives that we're trying to achieve as we set up funding policy. First and foremost is the contribution sufficiency. It needs to be enough to make sure that the plan is well funded and is going to maintain a sufficient funding status going forward and has enough money to pay out the benefits. Another aspect is demographic matching. So you might have a different funding policy for a plan that's, say, what's called a mature plan, where many of the participants are near retirement. Maybe you're not letting new participants into the plan. That can have a different funding strategy than maybe a newer plan that either just started or it's mostly actives that are just starting to earn their benefits. Or the plan might be somewhere in the middle. Volatility management is something that we're going to focus on a lot today. That's trying to manage how much fluctuation there is year over year and avoiding those spikes. Sometimes they're predictable, sometimes they're not. But how can you manage those so that you have as close to a smooth change in your contribution level from year to year, rather than having peaks and valleys? Transparency and accountability is also important. We want to make sure it's clear how those contributions are determined. So there aren't any questions on why they were determined to be what they are. And then finally, sound governance. Having a plan needs to be governed and making sure that those contributions are actually made and that the funding policy is followed. Moving on to the next portion of our background, we have some key components of a funding policy. First is the actuarial cost method. We're not going to go into this in a lot of detail today. There's some different ways to value the plan. They all get to roughly the same kind of result, but essentially it comes down to how we're determining what's considered the accrued liability. That would be what's earned by participants as of the measurement date. And so based on service and pay and what's owed to that participant based on what they've earned so far. There's normal cost, which is going 1 year further. So what's going to be earned during the next year? So if we're thinking of 1/1/2026, what are the value of the benefits that participants are earning during 2026? And then finally, there's the future normal costs. That is exactly what it sounds like. It's all of the normal costs or all the future benefits beyond that first year. So year 2 and later. Also within a funding policy is asset smoothing methodology. Essentially, if you have returns that are higher or lower than expected, plans can and often do what's called smoothing. So you'll recognize a portion of the gains or losses in the first year, and then they're phased in over a set period of time. That can be up to a handful of years. There's an amortization method. This is something we're going to talk about in detail today. This is when there's gains or losses in the plan, those are put into what's called an amortization base. So some of those causes can be payroll changes. That's something very common. So for example, let's say the participants in the plan, they were all given a 5% pay raise across the board to meet the competitive landscape. So that's going to directly impact their pensionable pay and will impact the liability for the plan. That results in an increase in liabilities, and that would result in a new amortization base. There can also be changes in employee demographics. People are retiring more often than expected or less frequently than expected. There can be assumption changes. So that would be something in the valuation, whether that's the discount rate that's used or how many people are assumed to retire and when, or the salary scale. Those can all be assumption changes that are made and can result in those changes in liabilities that are ultimately amortized into the cost for the annual contribution for the plan. And then finally, there's the plan changes. So if you're changing the plan provisions, that will also result in an amortization base. And then finally, contribution smoothing method. This is another thing we're going to talk about in some detail today. This is an option where you can smooth out what we'll define as the ADC, or the actuarially determined contribution. And that will allow for less volatility year to year, essentially taking your results and smoothing it out over time. So actuarial jargon, I talked about a little bit of this, but this I think illustrates some of the terminology that we often use in our valuations. The present value of future benefits is the bar at the top. That's the liability, or the value of all past and future benefits for participants. So we're looking at everything up until we're assuming they retire and going back to their hire date. A subsection of that in the second bar below that is the actuarially accrued liability. So I mentioned that earlier, but that's the amount that's been earned from each participant's hire date up until that measurement date. The normal cost is then the next year following that. So that's a 1-year measurement of the current cost for the plan. And then everything that's after that normal cost, that's the present value of future normal costs. And when we're looking at the funded status of the plan, we're looking at the actuarial accrued liability. That's that left bar in the middle section of the screen. And we compare that to the assets. So to the extent the assets are less than the actuarial accrued liability, that would be the amount that the plan is unfunded. If the assets are higher than the actuarial accrued liability, then the plan is overfunded or has a surplus. So next we'll talk about some conventional approaches for doing actuarially determined contributions. And I see we have somebody in the waiting room. I'll let them in. So the contribution is typically made up of a few components. The first of which is that normal cost. So what's the value of the benefits that's being earned in the first year, or in the upcoming year? That's what is a starting point for what should be funded, because we need to pay for those benefits that are being earned. Then to the extent that the administrative expenses are paid out of the plan's assets, those should also be factored into the actuarially determined contribution, or ADC. And that's the second component. And then on top of that is the amortization payments. I mentioned that a little bit on the previous slide. That again is essentially experience that's not already in the valuation. Gains and losses due to asset returns or assumption changes. It can be plan provision changes. Those will be amortized over a period of time. That period of time can vary by the plan, and we'll talk about that as well. But that's your third component. And then all of those are adjusted with interest from the valuation date up until the date when the contribution is expected to be paid, so that it's adjusting for that passage of time. So now, before we jump into some of the details of managing your amortization payments, let's talk a little bit about some of the payment options. First of all, you can look at either having closed or open amortizations. Closed amortization would be if you have a 20-year amortization, then it's going to, the following year, it'll drop down to 19, 18, and continue on. Open is also called rolling, which is where it's redetermined annually. Another option is looking at either doing a single base. So there's one base that's amortized every year and kind of redetermined as you go, as opposed to doing layered, where you'd have separate components for each amortization. So you might have one or two or multiple amortization bases determined each year, and then they flow to the next year. There's also level dollar or level percent of payroll amortizations. So a level dollar would be if you determine your dollar amount of your amortization payment, that dollar amount is going to remain flat over time, as opposed to a level percentage of payroll, where that's going to be assumed to increase along with the compensation costs for your employee base. And then finally, there's the amortization period. There's some flexibility in how long these these amortization bases can be amortized. I'd say at the low end, typically what I've seen is would be 15 years, and at the very long end would be 30 or longer. Tom, you can chime in if you've seen differently, but that's, I'd say typically what I've seen is somewhere in between that. 20, 25 years is a pretty common number for those amortization bases.
Yeah, Mark, that's what I've seen as well. You certainly have special cases. For example, I've had some clients who, for example, they've given a post-retirement benefit increase for existing retirees. And so because those folks aren't actively working, they wanted to get that paid off, but they didn't have the ability to pay it in 1 year. So they might recognize that and pay it down over 2 or 3 years, for example, just to make the budgeting process a little easier.
Great. And with that, we can move on to amortization-based management. Tom, do you want to take it from there?
Sure, Mark. If you go to the next slide, that'd be great. So what happens with a lot of pension plans is you end up with every year you do your valuation and there's experience different than expected, and you set up an amortization base to recognize that variation in liability, or you might have a plan change, you might have an assumption change, and all those things create their own layer in a typical amortization recognition policy. And so over a period of time, you could have if to Mark's point, if you're using a 20-year amortization period, you could have at least 20, maybe 30 or 40 different amortization bases, all getting paid down over a period of time, all with different periods. And the unique thing about pension plans, which differs from, say, issuing a bond from a government agency, is that some of the amortization bases will actually be credit bases, where experience was more favorable to the plan perhaps than had been expected. So we'll have both credit and charge bases. And that's part of what happens there. You have these offsetting charges, and there's actuarial reasons why you might be using a longer or shorter period of recognition for different sources. So, example, if you made a change in the benefit for your active employees only, you would probably look at paying that down over their future working lifetime, which could be a 20 or 25-year period, versus if you made a change just for your retirees, as we said, it could be a much shorter period of time. And so you have all these different bases. And so these recognition periods can come up and make a mismatch over time. And sometimes that mismatch of the credits and the charges and the different time periods can create some volatility. It can also create some situations where, and we'll show this in a few minutes in our case study, where you actually get the plan contribution being understated because of the timing of when these amortization payments are being made or the time they're being made over. And actually, some of this volatility actually was occurring with the state of Maryland a number of years ago, and they ended up making changes to their amortization approach because of that. Mark, we go to the next slide. So we thought the best way to illustrate this for the group would be to look at a case study. And here we had, this plan, for example, in this particular case, they reset their unfunded liability a number of years ago. I think they were going to recognize the unfunded liability over 30 years. So they're going to pay for the initial unfunded over a 30-year period. So this was a fairly large amortization base that they had. And then what happened is they've had this series of, in the years since then, they've had this series of ups and downs in their experience and different changes for plan changes or assumptions that are being recognized on a faster basis than this initial amortization period, which nothing wrong with that. That's not a problem. In this particular case, though, there was a pattern that they were getting more credits than charges. And that's where we're getting the issue here. So if we look at the next page, we see here, this is the numbers. We have a graph on the next page for those who like graphs, but what you can see here, if you just look at the very top line, that initial unfunded, 24 and a half years remaining on it, $169,000 payment. And then you look below that, you see some different credits and charges, but those are being recognized over a shorter period of time, a laddered basis. And every year there's a new amortization base. And the thing to take away from this is if you look at the very bottom, the total row, we have a payment all those credits and charges add together add up to a payment of just under $44,000. And this is a numbers crowd, so I feel comfortable talking numbers. $44,000, but it's paying off a liability of $1,132,000. So think about that in a bond perspective. If you had $1.1 million outstanding bond, and you're making a $44,000 credit or payment against that, however, you're being charged interest of, say, 7%. Well, 7% of 1.1 million is a lot more than $44,000. So in this case, even though each of these individual rows is doing exactly what it's supposed to do, in total, because of the mismatch of the timing and just the pattern of when these things happened, this plan is not actually paying off its liability. The liability is getting larger because of this mismatching situation. And that's something we generally want to try to avoid in a pension plan. Mark, we go to the next page, we can see the chart that illustrates this. So the unfunded liability is the gray shaded area. And you can see there, when you look at that, focus on that for a minute initially, you'll see that is actually increasing from our initial here, in this case, 1/1/26 up through 2034 before it starts to go down. So we're actually not paying anything off. The orange line is what our payment schedule looks like. So very low because of this mismatching time frame. And then all of a sudden there's a spike when you get out to about 10 years out, and some of those credit bases go away. And we have this dramatic increase in the cost, the cash cost of the plan that then is preserved for several years. Meanwhile, the blue line, tread water, that's what the contribution would have to be if you're just going to pay interest on the liability, not pay any principal, for example. And you can see, at least in these first 10 years, that blue line is much higher than the orange, which is why the gray is getting larger. So that's our situation. That's our problem, so to speak, that we're trying to solve for. And it's, again, nothing that anybody did wrong. It's just that the confluence of these different bases creates a problem. And it's something we look for in our actual practice to make sure that's not something that's going to happen. The good news is, though, we have solutions to this. A number of ways we can address them. So Mark, if you can go to the next slide. In this case study, we've looked at a couple of different ways to resolve this. And so our option one that we looked at was to say, you know what, as good as it feels to know that we're paying these things, all these other bases down over 11 to 15 years, to avoid this problem, what if we extend them all to that same 24.5 year period that our initial unfunded was paid under? So the change we made here for this option one is that column that says remaining years. The top line stays the same at 24.5 years, but all the other lines now go up to 24.5 years. And you'll see, because of the timing of the different credits and charges, the total on the bottom right-hand corner is now at $88,000 versus the $44,000 it was before. So even though we extended the amortization period, which on its face, usually you extend a paydown period, you would expect to have a lower cost. But in this case, because some of our bigger bases were credits, when we extend it out, we actually get a larger number. And now we're no longer in a situation where we're not paying interest on the liability. Now our $88,000 payment is more than the interest on the $1.1 million, and we're making progress toward paying down the unfunded liability. So if you go to the next slide, you can see that graphically. And here you can see the gray, which is the unfunded. It descends, it goes down over the course of the entire period. It's not increasing like it was in the previous slide. And the orange line, the payment, you see that's much more level. In this case, it's level as a dollar basis, and that is really very level. And then in 2050, when we get to the end of that 24.5 year period, it then drops off and goes away. And everything, again, you're above the blue line, which is your interest only payment, which is really what we want to accomplish. So this is one way of doing it. You know, of course, the trade-off was that you were paying $44,000 a year for this before, and now you're paying $88,000. But you're making progress, you're funding the plan. So this is one approach to solving the issue. We actually took a second look at it as well. If we go to the next slide, our option two, and this was, instead of extending all the bases to 24.5 years, what if we just extend the credit bases to the same length? And you'll see there that when you look at that remaining years column, only the years where the outstanding amount is in brackets or a credit is shown in the 24 and a half years. And you'll see here, because we did not extend the charge bases, the contribution is actually a little bit higher, almost $96,000 versus the $84,000 we had on the prior page. Again, still positive amortization. So this is another variation on this. We have a question in the chat about whether the $88,000 payment change each year based on new assumptions and plan changes. Yes. So if what we're doing in our projection here is we're using in our projection an assumption that in the future everything exactly matches our current assumptions, which of course we know won't happen. There'll always be variation. So yeah, so this is an idealized projection that shows things being level. In actuality, you would have something would happen in year two. There'd be a new base or new something that would change, and the number would change over time. Mark, if we go to the graphic on this. So this way you look at it, you can see again, we have a level contribution, again, assuming everything exactly meets our assumptions going forward, level for the first through 2038, and then it starts to come down as some of those charge bases that were at the lower number of years that were still in the 11 to 15 year period start to drop off. And then we hit this lower plateau that we go. But again, we're lowering the unfunded liability steadily over the point of the amortization. And of course, we're giving you two examples here in this case study. Depending on what the source of the volatility is, we could there's many different ways of approaching this. But it is something that we look out for when we do our work. We look ahead and at these amortization-based tables and say, is the structure of the table, is the incidence and the timing of gains and losses going to create a problem in the future? And we try to anticipate that and recommend changes. But there's a lot of, we give you two examples here, but there's other ways, of course, of extending or shortening things to allow the goal of not having a negative amortization, but we're actually paying down the principal a little bit while avoiding these sharp ups and downs. All right. So that's one sort of interesting thing that we see happen on occasion. Doesn't happen all the time, but it does happen occasionally. Another item we wanted to talk about was something called amortization base cliffs. And we saw that when we looked at the case study number one initially, you saw where the contribution became very high and then dropped off dramatically after a certain number of years. And that's because, again, it was a very large unfunded liability that was being paid off. And then essentially when you get to the end of that period, that's the biggest piece because it was some cumulative unfunded liability, for example. So scenario is you get a large liability, high contribution for a number of years, then it drops off dramatically after that as you reach a full funding position. And that's typically what happens or what can be projected to happen in some of these cases if you have that very large initial base. However, that can what we've observed in talking to our clients is sometimes that can cause a lot of stress on the budget. There's a lot of money being devoted to the pension plan. It's perhaps crowding out other payment or other uses of the money. And then there's this cliff, and all of a sudden now the payments are very low. And that can cause, now you have this, you can't do anything with this money until it gets paid off, but then you have this big change in your budgetary needs. And for some places or some organizations, that may not be a big deal, but for others, it may well be. But if we look at the next slide, we can see a graphic representation of what this looks like. So here, bars instead of lines. The orange is our current. So you see the orange, these are the contribution schedule. You see the orange marching upwards over this period of time. And then in 2036, it drops off dramatically, to about a third of what it had been previously. And so a question might be, do I have to go to that peak in 2035? Or can I start taking advantage of the fact that I'm getting better funded in advance of that? And yes, you can. There's some, within the actual profession, there's some guidance for this up or down. But this is something that can be discussed and looked at. Once you get to a certain well-funded position where you're comfortable with your funding level, not 100%, because 100% is where that 2035 occurs. But you could adopt the green schedule, for example, and say, well, once I've gotten to a pretty high level, in this case in 2030, I'm at, I think, 80% funded is what I use for this example. And then you can start backing off that contribution a little bit every year. So you never have that giant peak up and then dramatic drop down. Instead, you begin gradually lowering that pension contribution. It will push off the point in time in which you hit 100% funded. It won't be in 2035 anymore. But it will be something that you can, from a budgetary management standpoint, we feel that that's something that can be considered and talked about if you're in that type of situation. So again, that's something we typically look at with our clients and see where are they with these types of things. Not everybody will have this situation, but enough will that I think it's something that to keep an eye on. So with that brings up another approach. A lot of this is we've been talking about so far has been looking at a particular element of that pension contribution formula and trying to work with that. There are some approaches where you just look at the overall contribution and look at possibly doing some things to make that more smooth year to year. And we call that smoothing the contributions or output smoothing. I'm going to ask Mark if he could take over and lead us through that.
Yeah, thank you, Tom. So thanks for the lead in as well, and that's exactly what we're going to be talking about next. But first, let's compare some of the different funding policies that are out there, and one of those will be one of the smoothing approaches that Tom alluded to. So first, I won't spend a lot of time on this. It's just what we call a pure ADC or actual determined contribution. That's what we've been talking about so far. That's where you're paying your normal costs and the plan expenses to the extent that they're paid from the plan, and then you'll have those amortizations that will flow through as they occur in the plan, those gains and losses, and then they'll be reflected in your ADC. So that's a very common approach, and that's can have some of the volatility that Tom was talking about, and you can manage the amortization part of that if you want to stay within the pure ADC type of funding policy. Another option, which I would say is a lot less common from my perspective, Tom, you can correct me if you've seen this more frequently, but a less common approach would be what's called a fixed rate. And that's essentially you're paying either a fixed dollar amount, so that would be just a flat dollar every single year, or a fixed percentage of payroll, which is probably more common than the fixed dollar amount. But say maybe your actuary looked at the plan and said it should be about 15% of pay. So we're going to contribute 15% of pay annually. And then as compensation for the participants goes up over time, so would that contribution.
Yeah, Mark, I see this. It's interesting. These fixed rate plans, and again, these are usually set by legislation, sometimes at the state level, and the idea is that they would stay fixed for years. Not just for this year, but for decades. That 15% of compensation would be the contribution now and forever. You see that in different geographies. So, example, you don't really see it in Maryland a lot, but in, for example, Texas, it's very common. In Ohio, again, very common that you have these fixed rate approaches to funding.
Yeah, and it probably doesn't come by surprise, but there's a lot of risk that goes along with that, because if there's any negative plan experience or even positive plan experience where for example, your returns might vary from expectations pretty wildly. We've seen that in not too far looking in the past where we've either had really bad years. You can look at 2008, or you can look at some of the more positive years where returns have been better than expected. That's not going to be reflected in this methodology. It's still going to remain flat. So to the extent that over time the plan might become underfunded in this scenario, the contribution policy doesn't have a mechanism built into it to make up for that underfunded amount. So you're essentially hoping that returns can catch you up to be fully funded over time. Otherwise, some sort of additional corrective action would be required. So that would be legislation to change the fixed rate or changing the benefits that are paid to participants. Now, the third example we're going to look at is what's called a sticky rate. And this is kind of in between the two. So you're starting with an ADC in this example as your starting point for your contribution that's determined each year, but you're comparing to the prior year contribution amount and not letting it change by too much. And that can be defined by the plan's funding policy. So we have an example here where there's the sticky rate contribution is the ADC, but it's compared to the prior year contribution and it's not allowed to change by more than 10%. So if we walk through this example, in 2006, the pure ADC was 105,000. We compared that to the prior year contribution of 100,000. And then we look at the 10-year or the 10% corridor around that $100,000 that was the prior year amount. So it'd be 90,000 would be the low end, 110,000 would be the high end of what the contribution can be for 2026. Our ADC is in the middle of that. It's 105,000. So we stick with the ADC. And the sticky rate ADC for 2026 is 105,000. Now, if we look at 2027, we have a different scenario. Something happened negatively with plan experience, or maybe there was some of that amortization complications, I'll call it, that Tom was talking about, where something's driving the pure ADC to go from 105,000 to 120,000. So almost a 15% increase. What we do is we would take the prior year contribution, the prior year ADC of 105,000, put the 10% corridors around that. So that would be a 94.5 thousand on the low end, 115,500 on the high end. We compare that to our pure ADC of 120,000. And we see that the pure ADC is higher than the high end of the corridors. So we're not going to let the sticky rate ADC go above that 115,500. So that remains at 115,500, smooths out some of that volatility year over year. We continue that process annually. And we do have another example of the opposite scenario in 2029, where the contribution goes down enough where you're below that 10% corridor. So we're in 2029, we're comparing the 110,000 ADC to the low end of the kind of the sticky component of the sticky ADC calculation. So that'd be 112,500 would be the low end. So we, again, are limited by that low end of the contribution. So really limiting the volatility both on the positive and the negative ends of the spectrum. So looking at that example, or thinking of that example, we did prepare a couple of slides. This is going to be the really boring one. I promise the next one will be more interesting. But this is just to illustrate if we have a pure ADC or even the sticky ADC would be the same in this scenario compared to a fixed rate. If experience matches assumptions, which we know will never happen, but let's pretend it does, it's very boring. You're going to ideally stay at 100% funded every year, and then contributions under both scenarios will go up with compensation as the value of benefits and the value of those accruals become more valuable as the plan's participants earn higher compensation over time. So this is very simplistic of what would happen in an ideal world, but we know that never happens. So as a simple illustration, we have what would occur if there is an asset shock or a negative asset returns in 2028. In this scenario, we're comparing the assumed return of 7% to a negative 10% asset returns. We have about a 17% loss in 1 year. So looking at the chart, we have the contributions in the bars, and we have 3 of them this time. So we're showing the fixed rate, the sticky rate, and the ADC. And then in the lines are the funded status, and the color should correspond for each one. And so everything's going to be the same as experience matches the assumed return for the first few years before we have this asset shock. But then once we have that negative return in 2028, that's going to affect the valuation results that are done in 2029 and how the plan reacts to that, more or less. So let's first start looking at the fixed rate contribution. If we think back to a couple slides, that's not going to reflect any plan experience. It's going to be based just upon, in this case, the percentage of payroll. It's at 15% of payroll. So we can see the orange bar, the fixed rate contributions do continue to march up over time very consistently, but it's not enough to keep up and replenish that funded status. As we can see in the orange line at towards the bottom of the chart, it drops down to roughly 83% in 2029. And the contributions just aren't enough to keep up with that losses. Investment returns are going to be lower because you're getting returns on that lower asset amount, and the funded status continues to deteriorate. It's the contribution policy is no longer sufficient to keep the plan or get the plan back to a fully funded status. Next, let's look at the bar on the right hand of the set of three. That's the pure ADC method. We see a pretty large spike in the contribution. So it was a little over 300,000 in 2028 based on those results. And that jumps to about 450,000 because of that asset loss. In this example, there's no asset smoothing, so it's more extreme than you might see if you do have asset smoothing, but we're trying to show an example where the differences are very apparent. But you can see that then once the asset loss occurs, the contribution amounts jump up and then continue to increase as the value of those benefits continue to change over time, and that amortization is still going to continue into the future. So the ADC, if we look at the line on the bottom of the chart, that's going to be the fastest to get you back to 100% funded. So from 2029 to 2036, your funded status would go from about 83% to a little under 90%. So slowly making its way back to 100% funded. Not going to be immediate because there is a longer amortization period of, or I would say probably more of an average. I think this was a 20% or 20-year amortization. And then in that hybrid scenario that I mentioned, the sticky rate, that's going to be in between. We're reflecting that plan experience, but we're also limiting it so it's not changing as drastically year over year. So the middle bar in the set of three, we can see that increases from 2028 to 2029 more than the fixed rate would, but not to the extent that the pure ADC would. So that will continue on. And what actually happens in this scenario, because there's no other gains that offset the 1 year loss, the sticky rate at the end of the day needs to catch up with the pure ADC. So at some point in time, and in this case, that looks to be in 2033, the sticky rate contribution actually exceeds the pure ADC contribution, because both methodologies are trying to get to that 100% funded over time. It's just a matter of how and when the plan is getting there. But I think this kind of stepping back and looking at this, you can see that there's a pretty drastic difference in these funded methodologies, especially between a fixed rate and a pure ADC, where we can see almost a 10% funding gap at the end of 10 years due to just that 1 year of asset losses. And now we can just recap and look at the difference between those funding policies and look at some pros and cons. A lot of this we've already discussed, so I'll just go through it quickly. But when we think about the pure ADC, that's really the most actuarially sound, and it doesn't have quite as much smoothing. It's going to react the quickest to market volatility, but it can create contribution volatility. So there is that trade-off, and there's the importance of looking at budgeting, looking at those amortizations that Tom mentioned, if you're taking that approach, and at least being aware of any known volatility in the future and being aware that there can be volatility from plan experience. So for example, if you're halfway through the year and know that the markets are way down in your given year, it might be worth taking a look at how this is going to affect your ADC. Or if you have payroll, you know that there's going to be a large pay adjustment, and that's going to increase compensation costs. That's also going to likely flow into your pension costs. Something to think about is that, avoiding surprises is always the best approach. Fixed rate on the other end of the spectrum, that's going to be very predictable and very easy to manage politically, because everyone should have a good understanding of what the contribution is, how it's made, and what it should be going into the future. But of course, that comes with those risks that we talked about. There is definitely the downside risk of what happens when there's negative returns or negative experience. The plan just isn't meeting expectations or the assumptions to keep it fully funded. And then to the extent that requires any corrective action in the future, that creates intergenerational inequities. You'll have a group of people who, or essentially the payers of the plan, those are going to pay for the benefits that have already been earned, but that might not have been sufficient for that plan. That the benefits were earned at that time, and then the payers later on are going to have to pick up the difference in order to keep the plan and get the plan back to a healthy status. So it does create that, or has the potential to create those intergenerational inequities. And then the sticky rate, that's going to be your in-between kind of hybrid approach. So you do reflect market experience, just not as quickly, but it does result in a more predictable contribution when compared to the pure ADC, just not quite as flat as the fixed rate. And I think that covers it. I'll give a second to see. Is there any questions? I can't see the chat.
Yeah, no questions on the chat right now, Mark. One
Okay.
thing to note on these sticky rate plans, if you ever encounter one, there is a whole decision tree, usually fairly complicated decision tree that goes behind how the rates will go up or down in a given year. Now, what we demonstrated today or illustrated today was a very simple, no more than a 10% change in a year-to-year basis. But again, then when you look at them in real life, they have a lot of very, and sometimes very complicated decision points on how that goes up or down as they try to manage these pros and cons. So it's just interesting things you see, in say in Texas where they have the fixed rate as a more dominant approach. They also require a fair amount of what they call stochastic modeling, where you're building in probabilities about what will happen in the future on a long range basis to try to set that fixed rate and then reassessing that on a periodic basis. So it's not as simple as throwing a dart at the wall and saying we think 10% or 15% is good. There's a lot of sophistication that they use to go into that to try to avoid some of the issues that Mark mentioned in his illustration, where he showed that in that case, the fixed rate plan was not going to keep up with what was needed.
Is there typically a point where the rating agencies get involved and say that we're concerned about the funding level, and they start to make comments about it?
So yes, they will. They all do it differently. That's why I couldn't just say yes straight out, because they all have their own approach. But what they're going to do, generally speaking, the rating agencies will look at the contribution and they'll look at your liabilities and say, if we, the rating agency, had this and we were going to do this in the conventional way, how much contribution would be needed? Or put another way, how quickly is this fixed rate going to pay down the unfunded liability? And how does that jive with our view of what a good governance policy would be? And they may ding you. If they look at your policy and say, yeah, we did some analysis of our own, and your approach is not going to pay this unfunded liability down for 50 years, and we think you should be no more than 25 years, then that's going to be a negative in their overall assessment. So those types of things are definitely out there because they would look at that as a possible situation where the entity would have a cash call at some time. So if they're saying this isn't really being funded, you think about Mark's example where the unfunded liability was getting worse and worse in the fixed rate plan, they would basically say, that's not going to happen. They're going to have to pay these retirees eventually. And that's going to mean there's going to be a big cash call, which means they may have stress in trying to pay off their bonds. And so we're going to give them a lower credit rating. I can't tell you how much weight they put on that, but they definitely do look at it.
Okay.
Thank you. Why don't we go on to the next topic if we can? So this is a more cheery topic, surplus management. So what's surplus? Surplus is where you get ahead of your targets. So you have more assets than liabilities. The big drivers generally tend to be investment returns for this, but also some management decisions about contribution rates and plan changes you made over the years. There's a lot of plans that have back in the '08 financial crisis or post the '08 financial crisis, they reduced benefits for new employees. And as those new lower benefit groups become more the dominant demographic, you'll see some tail off, and you can see the plans get better funded much more quickly. But if you go to the next page, Mark, being in a surplus or 100% funded or more is really not done. You're just ahead of schedule. So the actual accrued liability, think about that colorful chart Mark showed earlier, where you had the accrued liability as a subsection of the total liability. That's just where you're supposed to be today. It's not where you're going to be tomorrow, because people are still earning benefits. And so the idea of that you're in surplus and you can be finished making contributions is a little bit of a myth. But it does provide some different opportunities for discussion. If we go to the next slide. Why discuss this? So what our advice is when a plan is getting to be, well, at any point in time, but definitely as it gets into the 80s or even 90% funded, if you don't have a plan for what to do when you reach surplus, you need to have that plan. Because if you can have the discussion before you reach 100% funded, then it's a lot easier for all the pension trustees or other stakeholders to understand the issues and make decisions sort of without the politics of what happens. Because what can happen in a surplus situation, and folks on the call probably know this better than I do, is you got a lot of competing forces. You might have the finance officers, no offense to the current audience, who might be saying, oh, goody, goody, I can reduce my contribution. I can use this money somewhere else. But on the other side, you might have labor, and labor might be saying, we had some pension givebacks a number of years ago, and now we want to get those back. So we want you to sort of spend that surplus on providing a benefit. You'll have retirees who may come forward, and I was in a situation like this not that long ago. I came to the pension board meeting, and the room was full, which it never is, and everybody there looked like they've been retired for 10 or 15 years, and they were there to request that the board consider giving them a post-retirement cost of living adjustment, which their plan didn't provide, because they had reached this quote unquote surplus position. So a lot of folks, when you get there, there's a lot of people who say, hey, I want to take advantage of this. And so our approach is to have the discussions, decide on what you're going to do when you get there well before you get there, so that you can do it in a calm, rational manner, and everybody, no one is looking at an immediate need of what's going on. Just from an historical standpoint, for those of us who were practicing in the 1990s, just so you know, we were all investment geniuses in the 90s. Essentially, you could invest in anything, and it was going to give you a 15 or 20% return. And everybody thought that would go on forever. But then we had the dot-com bubble burst in 2000, 2001. We had the recession in 2008. And that decade, we essentially had zero return for over the course of the whole year, of the whole 10 years. And that is what put a lot of pension plans in the trouble that they had spent the last decade, the 2010s and the 2020s, fighting their way out of. So we want to avoid that mistake of getting too excited, because at the end of the 90s, a lot of plans gave benefit improvements. A lot of employers reduced their contributions, and it created a real issue when that crash occurred. So going to the next slide, what's in the plan? Plan for what's next. Integrate this idea of what you're going to do when you reach 100% funded into your funding policy. So it's an integrated policy. This helps to minimize the pressure when you get there. No one has to decide what to do. We've already decided what to do. We already have the plan in place. We already know what's going to happen. Helps to avoid that temptation to satisfy any short-term needs. Like, hey, I can use this budget money over there, or I need to give this cost of living adjustment. Avoid that short-term thing. Avoid those mistakes from the 90s when we had that great run-up. Also keeps us from overspending. That was part of the 90s. If we're going to get 15% return every year forever, we can give away huge benefit increases. It's free. So people overspent. You can also balance with your other needs. So that's what we think about when we think about a plan for this. And then we think about what are the components of the plan as we go through this. So if you go to the next slide, please, Mark. The components are 4 things we want to look at or put into our plan. And there are four key things: assumptions, risk reduction, contribution policy, and benefit enhancement policy. Those are the four items that we want to make sure are accounted for in our surplus, uh, policy. Go to the next slide, Mark. So assumptions, that's how we think the future is going to be. And we know that, as Mark said before, that the future will likely be either more or less favorable than what we're anticipating. So what we always advise for a plan that's getting close to surplus is, even more than usual, do a real hard look at the assumptions that are being used. Are they realistic? Is there anything in there that possibly is a little bit aggressive and that might catch you later if there's some sort of a turn in the world? So, for example, if you're using a mortality table, but you've adjusted it to say, my group's not going to live as long as the general population, is that something you should change? Is your expectation for investment returns too aggressive on a long-term basis? So, how do you make those adjustments? How can you say, what would be a little more conservative before you start, celebrating and saying we can now move on to giving money away? Really tighten up those assumptions. Every pension plan generally looks at these every 4 to 5 years anyway, but a little extra rigor, a little extra discussion about what goes on there. Make sure there haven't been any holes that have opened up in those assumptions, in the strength of those assumptions. So that's step one. Step two, we'd say, would be go to risk reduction. And that is to look at, what is a good target stable funded status that you can go to especially avoid contribution volatility. It's an interesting thing that if you're a very poorly funded plan, say you're 25% funded, investment returns don't matter a lot because you're generally not worried because they're not that big compared to your overall liability. That's the silver lining of a black cloud there, that the investment returns don't matter if you're that poorly funded. But think about when you're 100% funded, exactly 100% funded. You have a contribution that's just the cost of benefits being earned the next year if you're following a traditional ADC approach. But then if you have a slight investment mismatch, say investments, instead of investments returning 6.5%, they do 5.5% in a particular year. That 1% difference, because you're looking at very large numbers, your assets and liabilities are both very large numbers, that 1% mismatch in that 1 year can create a very large volatility, a very large difference in your contribution. Your contribution could double in that year because you're not paying off any liability. So it's a very unstable contribution. So risk reduction, looking at your investment allocations, make sure it's aligned with your plan maturity. So if you have 2/3 of your population are retirees, maybe your investment allocation should reflect that fact that a large portion of those folks are on a fixed income versus those whose pensions are growing. Make sure it follows your needs. Build in some margin for adverse experience. That's something you can do as you get to there. Say, when we get there, we're not going to stop contributing until we get to 110% funded or 115. So we have that margin for adverse experience. So in case something happens, it's not going to disrupt the budget. And do some enhanced risk analysis. So figure out where are the sources of stress. What is the scenario that would cause a lot of deviation? So this is the risk reduction portion of the policy. If we go to the next slide, we look at what we would call the Mark, we go to the next slide. Mark, are you frozen? Oh, I think we lost Mark. Let me share my screen. Okay, sorry about that, folks. Okay, so you can see the contribution policy there. And here the idea is that you're trying to avoid ups and downs in your contributions. Many governments struggle with big swings. We want sustained relief. So part of the policy is to determine when you want to take credit for being at that 100 or plus 100% funded. And how much credit do you want to take? So it sort of gets to that sticky rate stuff that Mark was talking about. How much credit do we take who gets the credit and when they get the credit. Um, Things called a reserve stabilization fund is a technique where you essentially say we're going to ignore a piece of the assets until that piece builds up to a certain size, just so that we can draw on it when we have that adverse experience, which will happen in the future. So a lot of different things that lead into that contribution policy. And finally, benefit enhancements. So usually pension trustees don't drive plan design, but labor does, management does. Um, Generally speaking, we want to, when you're at that point of having surplus and before you enact benefit enhancements, to really look at some stress testing to understand what could go wrong. Because that was one of the lessons from the 90s, is that the people raised benefits just as the market crested. And then when the market went down, they had a lot of trouble paying off those benefits. And if you think about 2008 and on the Great Recession, a lot of plans had the same issue. They had higher benefits and they had to reduce them. Um, the ones that are most easy to give are non-permanent increases or variable structures so that there's some flexibility if things go wrong in the future. Our takeaways from the surplus management discussion is that it's great. Things have gotten really well funded for pensions, especially in Maryland. We think a lot of Maryland pension plans are very well funded. But part of what happened was tightened benefits and higher contributions. That's how we got there. So now that we're getting closer to 100%, there's going to be some. We've seen in other jurisdictions where there's tightened benefits, there's a call to relax some of those tightened benefits. Where there's been higher contributions, there's a call to lower those contributions. So the idea of putting together a surplus management plan in advance allows you to navigate those issues without having a major crisis or a lot of push and pull. I'm going to stop sharing here. And that's really the whole presentation. So, we wanted to make sure we gave you some food for thought. These are things, even with our own clients, we don't generally talk about every day. So they're a little bit more adventuresome topics in pension funding. So we just want to give you a flavor of some things that are available there, and happy to take any comments or questions folks might have.
Typically, in your experience, what percentage of salary are people seeing is in their pensions? Is it 25 to 45% of full salary or something different than that in the public sector?
Yeah, it varies a lot between public safety and non-public safety folks. So probably think about public safety, police and fire, corrections officers, for example. Typically, they have a shorter career and retire earlier because of the nature of their business. So you will see those 25 to 45% of pay contribution rates in those groups as sort of the gross contribution. Usually the employees are paying a piece of that, but the employee side is usually, 7, 8%, maybe as high as 9%, though it does vary a little bit here and there. In the non-public safety side, you'll see more typically the 15 to 20%, I think, contribution rates. One of the big drivers in terms of what those rates end up being is whether the plan has an automatic built-in post-retirement cost of living adjustment. So plans without that cost of living adjustment being built in, who do it on an ad hoc basis or just don't provide it, their numbers will be lower. A plan that has that automatic cost of living adjustment built into it, you'll see those rates be a little bit higher.
Okay, if there are no further questions, we want to thank you for your presentation today. I thought it was a great presentation for the group, and glad to have you with us. And if anybody else on board would like to make any suggestions for future webinars, we'd be glad to take those recommendations from you. You could email us or just contact the board members, And thank you so much, Bolton. And you kept it within the 2 hours with no problem. So,
Right. We figured an hour of actual discussion on a Friday morning was as much as people could really take. We didn't want to overstay our welcome there.
okay, we do have a message I saw just come on. Do you have time for one chat message? Some
Sure.
says a chat message, and I think you'll take that.
Yeah, happy to.
This is Karen. I think it was my question you were reading. Time for one question.
Yes.
Okay. So Tom, thank you so much, both of you, for the presentation. I found it very helpful. Really appreciate it. The last part of the presentation where you talked about, as you near the 100% funding level, and can you hear me okay, by the way? I should have asked.
Yes, Karen, we can hear
Okay.
you.
As you near the 100% funding level, taking into consideration to ensure you don't get overfunded is the way I'll summarize it. And that sounds so similar to what we had done on the OPEB side of things. So as I'm focusing more on pension, do you have any feedback about whether you generally see policies like that? If governments are on the ball and are crafting policies like that, if they are adopted by the executive branch, by finance departments, by county executives or city managers, or if they are more adopted by the legislature in resolutions, or, with the weight of law behind them, that kind of thing.
So I guess two answers. One is part of the reason we introduced this surplus topic to this conversation is that we do feel that in our experience, we haven't seen a lot of employers and pension plans with a formal policy about what to do when they reach 100% funded. So it's just been the chips will fall where they may when you get there. And so that's something we observed that and said that could cause some issues in the future. And that's why we're bringing this topic out so that folks can start thinking about it. In terms of where the policy lives, it really should be part of whatever the contribution policy is. So it really piggybacks on that. So if the legislature of a jurisdiction is the one who, or the county council or the town council, whatever it is, if they are the ones who own the policy through a legislative approach, then this should be made part of that legislative policy. If it's something that the board itself, the pension board has control over, then they're the ones who should do it. But it should be formal, in our opinion, and it should be documented again so that you can hash out the details and the how and the what and the why and the when before you get to the point where people are looking at it and saying, "Ooh, I could really use that money." It's a lot easier to decide these things 5 years, 10 years before they occur than when you're looking at it right then and there.
Okay, thank you. Can I ask you a follow-up question? Because your answer triggered another thought, and that is that I'd mentioned OPEB, and that's the relationship that we have with you. And so Bolton has been very, the word I would use is forward focused on the healthcare side of things, with, for example, kind of being the first ones out there to encourage or just citing the benefit of organizations looking at the value of maybe not focusing on 100% funded for OPEB plans. So we have appreciated so much Bolton's advisory perspective, right? Helping us to bring a different lens, a wider lens to our policy analysis. Do you find this topic of as you get close to 100% funded, all the considerations you should bring to the table from a policy perspective to ensure you don't wind up, let's say, accidentally way overfunded and then at the mercies of other political processes that could want to tap into those funds in a different way? Do you find that many pension actuaries are advising their clients, are putting this on the table, are having these conversations with their clients, or do you find somewhat of a dearth of those conversations from actuaries? And so that's another reason why you're stepping in and bringing this up.
Yeah, so in theory, we should be seeing more of this conversation. So I was part of a team. So the actuarial profession has several professional organizations. One's called the American Academy of Actuaries. And I was part of a committee at the American Academy where we actually wrote a paper addressing this surplus issue, and trying to put that out there. And so that was actually distributed maybe about 6 months ago. We finished that work and it went out. And it was written. I'd be happy to share it with the group. It was actually written with the focus not so much of talking actuary to actuary as talking to pension plan sponsors, but it was covering some of these very topics we talked to today. I know when we go to different professional conferences and talk to plan sponsors who are not Bolton clients, it's a mixed bag as far as how many have had this surplus conversation or not. So it's a mixed bag, Karen.
Okay, thank you. Thank you for the framing it about the American Academy of Actuaries, recent focus. And yes, if you would be willing to share that paper with these attendees, I know I, as one attendee, would be very interested in it.
Okay. We will
Thank
do.
you.
Thank you, Karen. Thank you, everybody, for your time. Really appreciate the questions as well as your making the time to do this on a Friday morning. And with that, we'll close. Marty, you have anything
Okay,
else?
thank you so much, and you have a great weekend.
Thank you. Take care.
Thanks,
everyone.
everyone.
Great.
Hey, Tom,
Yes.
Uh,
do you have a second?